Hi and welcome to this week's edition of Maqro Minutes. I'm Mark Gardner, Head of Trading here at Maqro Capital. As per usual, we'll start with the disclosure. This is obviously general advice. It doesn't take into account your personal situation. There's risk involved in trading, and this advice may not be suitable to your needs. So, as we will start with stocks in our universe, we've got Challenger, Raise and ALQ. Now, first up we're going to cover today is Challenger, CGF. It was one of our recommendations last Monday. Although its first half year results largely missed expectations, revenue was down 23%, but it was only really missing expectations by 3.5%. The net income was down 28.5%, which only missed expectations by 2%. But in terms of the divisional performance, its life division provides like retirement income solutions, saw sales up 10%, and the net book growth was around about 4.7% in the first half of 2021. Its funds management division saw record half-year results with net inflows of 6.4 billion. The outlook's really positive on this stock. Management noted that earnings will be weighted to the second half of the year. The momentum is expected to continue into the second half due to the deployment of life cash over the second half of this financial year. They reduced their expenses as well to previous years. So CGF's also partnered with MS and AD Group, which is the largest general insurer in Japan. This will increase Challenger's access to the Japanese retirement market, which is very large. It's also shifting strategy and expanding its retirement offering by acquiring My Life, My Finance. This provides CGF the opportunity to significantly expand its retirement income offering by entering Australia's $1 trillion term deposit market. These expansions align with their strategy to increase market share and will provide Challenger with access to a range of customers and multiple distribution channels. On a macroeconomic level, a rising rate environment really favours Challenger's life investment portfolio, as 76% of it is comprised of fixed income assets. Next up, we've got Raise, RZI. This is another one we released a recommendation on earlier this week. So Raise is a mobile application, and it basically facilitates commission-free micro investments by allocating or rounding up excesses from transactions on daily purchases. These recurring investments end up in lump sum deposits, and then it's then converted into one of 7 ETFs. One option in that is crypto as well. So Raise has currently got about 600 million on its books in Australian funds and management. It's on track to hit $1 billion by the end of this year. So we forecast RZI to hit the 1 billion milestone much sooner with its aggressive expansion into Thailand and healthy customer growth in Malaysia and Indonesia. It's also very attractive to millennial investors as well, which is a surging sector of investors, according to the ASX investor profile report they released this year. This will mean its transaction volume is expected to grow pretty heavily over the second half of 2021 because it's gaining traction, across the board with that millennial customer base, who apparently on average spends, invest 7 pp on average move more than the baby boomers. So we really do. It's had constructive price action this week as well, and it looks to be moving to the upside technically as well. Next stock we have is ALQ or ALS. In the past week, key highlight for ALQ was the acquisition of Investiga. And now this is a pharmaceutical testing business specialising in cosmetic and personal care market. They've got operations in Brazil and the east coast of the US. The buyout sees them acquire 100% equity Investiga at a multiple of 11 times adjusted, paid from existing debt facilities. So they haven't had to go on capital raise there at all, which is very positive. The acquisition aligns with the management strategy to grow its life sciences division, which has been resilient. They also provided a trading update this week, just in regards to their geochemistry sample flows. They increased by 13% in the third quarter 3 last year, and versus PCP off the back of strong performance by the major miners, with momentum expected to continue into Q4. In the industrial division, Tribiology has seen some improvement, whilst the trading environment for asset care remains challenging. This is in line with our thesis on the early capex cycle in the mining sector. So next up, we're going to go to stocks to watch out for in the next week. So I think we're going to start with Afterpay. So it's been wild times in Afterpay since Monday, particularly. We saw the stock open up around sort of 118 rally in the first 30 minutes on Monday morning to 121 before a large sell-off was triggered. I think it settled at around about 111 on Monday afternoon, which is a fairly significant sell-off. This coupled with the overnight, the Nasdaq then came off as well, and the stock opened up at 105 and very quickly took a turn for the worst down to I think a low of 99.40. There was a lack of stops down there below $100, which I found a little bit surprising. I thought there might be some stop loss levels there. So basically, the stock bottomed out a little bit around that area, and then rallied up to finish at 107 on the day, only down about 3.5%. And then today has rallied significantly again. I think it got up to a high of about 118 as of sort of about midday today. So. Look, it's a bit of a market darling, Afterpay. Its performance was in line with the wider tech sell-off, really, except for the extreme moves at either end, which is basically in line with the inflation trading infiltrating through from bond market yields rising, which that trade has softened a little bit with yields coming back down off highs in the last sort of 3 days. There's been some Reserve Bank comments and generally some US stimulus package coming into getting approved in the Senate as well. So they're not the urgency around that inflation trade really has dissipated for the time being, but no doubt will rear its head again at some stage. Any interest rate spike could really put further pressure on APT's share price. And it obviously is very, very sensitive to that inflation story popping up again. Next up, we've got Macquarie Group. So, look, complete sort of opposite story realistically to Afterpay. It's just kept on rallying really. It's benefited heavily from its guidance upgrade about 2 weeks ago, which was that North American gas shipping because of the Texas hurricane storms, etc., the cold snap. Where they made about 3,000% on their on shipping gas into the area. It's also benefited from sector tailwinds. The financials have been pretty strong over the last couple of weeks. Very positive price action. They've led the rallies generally, and then held up quite well on the days that we've been down. I think the financial sector, as of this morning, was up about 6% in the last week. Looking forward, interest rate concerns, recovery theme, and overall higher trading volumes probably will provide further support to Macquarie's share price. So we're fairly happy with this stock at the moment. And last but not least, RWC. They delivered solid results across the board in their half-yearly update, with beats in operating leverage, strong cash flows, strong balance sheet. Revenue was up about 13% versus period comparison, at 642 mil. NPAT was up 82% to 91 mil, or 91.5 mil. The strong top-line revenue growth was supported by favourable demand drivers, increased repaid and modelling activity, and higher residential construction volumes. As a result, management started to look for further future growth opportunities, indicating there's a possibility of some potential merger and acquisitions or share buybacks while maintaining top-line growth for its core business. Looking ahead, most important factor to consider is how long current construction-led recovery will last. UK GDP and construction output data coming out in the next week. It'll be an important indicator of the demand in a lagging EMEA market. We see new product launches and continued strength in the housing market in the US and Australia will provide tailwinds. However, the delayed impact of Reliance supply chain from rising copper prices throughout 2020 is potentially going to weigh on margins in the second half of this financial year. Looking ahead, so what to expect over the next week. 11th of March, we've got US releasing its CPI numbers. That's tonight at 12:30. Forecast to be 0.4% growth month on month. We'll deal with a great deal of concerns recently centered around interest rates and inflation. Any variance from the expected 0.4 could result in swings either way in equity markets or just markets generally. Given the worries about inflation over the last 2 weeks, I really can't see this being a strong number in comparison to what the market's been panicking about in the last couple of weeks. As most central bankers have said, there will be pockets of inflation. There won't just be an underlying lift straight away, and we're realistically looking at it being more of an issue towards the latter half of this year, early half of next year, rather than results from the first quarter of this year, where we're still seeing a lot of economies reopening and vaccine rollouts coming through. So I wouldn't expect that number to be particularly strong or to worry markets too much, given the recent increase in inflation expectations, probably going a little bit over the top. Now, 12th of March, Friday, ECB is holding a press conference. I dare say they'll be dealing with pretty similar sort of stories with the recent rise in bond yields. There'll be an update on their monetary policy and maiden refinancing rate. German inflation rate has risen for 2 consecutive months, but we're talking 1% and 1.3% in January and February respectively, which aren't overly significant. And look, it may have been an initial spark for inflation concerns, but we realistically see you need to see that maintained consistently, those sorts of numbers for there to be any major worry. Obviously, the ECB will definitely comment on this. So next Tuesday, 16th of March, US is going to release retail sales figures. Forecasted to be up 5.3% month on month. Investors will be eyeing this to determine if consumer spending is, what's going on with consumer spending, whether it's slowed down post-seasonal impacts from end-of-year holiday spending, or whether people are spending money, in anticipation of their stimulus checks coming through. So there should be interesting times ahead with economic numbers being fairly key importance. So, and that pretty much wraps up for now. Thank you for listening to the Macro Minutes, and we will chat again next week.